Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Fatin Hanimah Surah binti Abdul Wahab. My matric number is 286812. So I'm from Group C. We present about assignment 1, which is the company performance. So our group have choose cepat wawasan group berhad as our company report to make a comparison through the company financial performance in 2022 and 2023. So now I'm going to present some of company overview. So our company chosen is a Malaysia-based investment holding company listed in Bursa Malaysia that comply with Sharia compliance. So CGP is in the main market in the plantation sector and operates through 3 segments, which is plantation, oil mill, and power plant. So it primarily operates in Sabah, Malaysia, where it holds a land bank of approximately 10,280 hectares. And the company has invested in renewable energy sources, including the operation of approximately 12 megawatt biomass power plant and a 4 megawatt biogas power plant in Sandakan, Sabah. So the company also owns an oil mill in Sandakan with a milling capacity of over 90 meter tons per hour. And so CGP, which is Cepat Wawasan Group Berhad, was incorporated in Malaysia under the Companies Act 1965 on 11 January 2001 as a sole proprietorship limited to facilitating the restructuring of SMP food industry Berhad. And it's become a public limited company on 9 March 2001 and assumed its current name. And then on 24th October 2001, CGP was listed on the second board of Bursa Malaysia, which is Security Berhad. And after that, it's transferred to the main board of Bursa on 11 December 2006. So that's overall of overview of our company. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Aishwarya binti Azami. My matric number is 285216. Now, I will continue this presentation about calculation and analysis of company financial performance. There are 5 types of ratio that we can use to identify the company financial performance, which are liquidity ratio, activity ratio, profitability ratio, leverage ratio, and market value ratio. The first ratio is liquidity ratio. The liquidity ratio is basically a technique that is used by the company to transform its current asset into cash. Thus, this ratio is very important to creditors, especially banks and suppliers. From liquidity ratio, we analyze the current ratio and quick ratio. Current ratios is used to determine if a company can use short-term assets to cover down short-term debts, which are liabilities in less than a year. The formula of current ratio is current assets per current liability. From this table, we can show that the current ratio for Cepat Wawasan groups in 2022 and 2023 is 3.06 and 3.43 respectively. By this ratio, in 2022, the company can pay its short-term debts by generating Rm 3.06 in current assets for every Rm 1 in current liabilities. Meanwhile, in 2023, the company can pay its short-term debts by generating Rm 3.43 in current assets for every Rm1 in current liabilities. The both of current ratios are greater than 2, so it indicates that the firms can pay its short-term debt and may have too much either capital in cash or tied up in stock. To short-term creditors such as supplier, the highest this ratio is better, but it's also could indicate an inefficient use of cash and other short-term debt, other short-term assets. So the current ratio in the year 2022 is better than the current ratio in the year 2023. Quick ratio is used to compute a firm's ability to cover its short-term debt quickly using its liquid assets. In general, a quick ratio which one can be considered satisfactory. The formula of quick ratio is quick asset per current liabilities. From this table, we can see that the quick ratio for cepat wawasan groups in 2022 and 2023 is 2.45 and 2.87 respectively. Both of them were more than one, implying that the firm can immediately settle all current liabilities, since for every RM1 in current liabilities, RM2.45 and RM2.87 will be available to pay down the debt in 2022 and 2023 immediately. The second ratio is activity ratio. In a nutshell, the activity ratio indicates the level of efficiency and capability of management in operating their business, especially in assets management of a company. From activities ratio, we analyze the inventory turnover, the total asset turnover, and cash conversion cycle. The inventory turnover is the number of times the average inventory has been replaced over a given accounting period. The fast inventory turnover enables stock to be quickly converted into cash. The formula of inventory turnover ratio is cost of goods sold per average inventory. From this table, we can see that the inventory turnover ratio in 2022 is 11.16 times, indicating that the company will need to add or replace 11.16 times its inventory in that year. Meanwhile, in 2023, we can see that the inventory turnover ratio is 11.96 times, indicating that the company will be to add or replace 11.96 times in inventory in that year. The inventory turnover ratio in 2023 is higher than 2022. The higher the inventory turnover, the better it depicts the firm's ability to sell its product quickly and keep less cash on hand. It can be proved by the days sales for 2023 just taking 31 days by 365 per 11.96 compared to 2022 that takes 33 days by 365 per 11.16 before it is sold. However, inventory turnover with a low ratio means the inventory held is in excess or sales conditions are sluggish. The total asset turnover depicts the number of times the average total asset used for a certain accounting period. It measures how efficiently a company can generate and produce in sale or revenue from its asset. The formula of total asset turnover is sale per total assets. From this table, we can see that the total asset turnover in 2022 and 2023 is 0.72 times and 0.61 times respectively. This shows that for every RM1 in asset, the company generates the sale RM 0.72 in 2022 and RM 0.61 in 2023. The more total asset turnover there is, the greater it reflects the quantity of product or service sold per ringgit Malaysia of asset used through time. In contrast, a lower total asset turnover means a company is not efficiently generating sales with its assets. The cash conversion cycle measures how fast the company can convert its cash on hand into inventory and then convert inventory back into cash. This is figuring out how long this cycle takes and how many days cash will be tied up. Formula of cash conversion cycle is average day inventory plus average day receivable minus average day payable. In this table, we can see that the cash conversion cycle in 2022 is 36.49 days, and the cash conversion cycle in 2023 is 70 days. This shows that the period of cash conversion cycle in 2022 is better because it just takes about 36 days for the company to convert cash into inventory and convert into cash back compared to 70 days that is needed in 2023.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Qayyum bin Haji Muhammad and my metric number is 2909. So I will going to continue the presentation, which is my part is about the third one is about the profitability ratio, and it will cover by the three things, which is net profit margin, return on asset, and the third one is return on equity. Okay, so I will going to more fast about my first one. This is about the net profit margin. Okay, the net profit margin, it is the formula we need to calculate about the net profit margin, with this net income divides to revenue, and then we got the answer, and we need to convey it to the percentage. We got here at the 2022 it is 5.600%, and we got 2023 101 and 73%. It is for our selected company. Okay, for the second one is about the return on asset. The return on asset formula, it is about the net income divide average total asset, and we got the answer here 2,209,739.9. This is about the 2022, and go to the same formula about the return on asset. We got the answer here for 2023 is 201,333.33. This is about the return on asset for this company. Okay, for the third one, okay, we go to the return on equity for Cepat Wawasan Group Berhad, which is our formula we using is for the return on equity. It is about the earning after tax divide to shareholders equity, and then for the answer in percentage, of course we need to multiply 100. So we got the answer with percentage. For the year 2002, we got the earning after tax 33,235 divide 200 400,000 403,894 multiply 100. So we got 8.228% for 2002, and for the 2003 also we use the same formula, and we got the answer is 5.050%. It is for the return on equity for the Cepat Wawasan Cepat Wawasan Group. Okay, for the next part, which is about the leverage ratio, with it we cover two things. This about the debts to asset, and the second one, debts to equity. Okay, for this one, we go to debts to equity. The formula is total liability need to divide to total asset. So for 2002, and we got the answer is 18.886%, and for 2023, sorry, we got the answer is 0.01 percentage. Okay, for the last one, we cover about the debt to equity ratio. Okay, for the formula to calculate debt to equity ratio, it is about the total liability divided to total equity. Okay, so for 2022, we got the answer is 18.886 percentage, and we got the answer for the same formula, total liability divide to total equity for 2023, we got 0.01 percentage. So that's all from me about the covering about the leverage ratio, about the debt to equity and debt to asset, and also I have covered about the profitability ratio, that we have three: net profit margin, return on asset, and return on equity. That's all from me. Thank you so much.
So as I said earlier, my name is Fatin, office matric number 286812. I will present for the next part, which is calculating part for measuring company performance. So the last ratio used to measure this company performance is market value ratio, which is contains two ratio, which is earning per share and price earning ratio. So, what is earning per share? Earning per share is common metric and that used to carry out corporate value, or can be defined as earning per outstanding share of common stock of the company. So, EPS indicates the company profitability by showing how much money a business makes for a share of its stock. So, for our company, which is Cepat Wawasan Group Berhad, their earning per share is in 2022 is RM 10.21 cent, with net income and share outstanding 2,000.39 million and 1,997 and 60 ringgit respectively. Meanwhile, the earning per share in 2023 is 6.6 times, with net income and share outstanding with 31 million and 4 million respectively. And this show that for every one in share, the company generate income RM 10 ringgit and 21 cent in 2022 and 6 ringgit 60 cent in 2023. It shows that our company earning per share is higher in 2022 than 2023. So for the last part is price earning ratio. So what is the PE ratio? PE ratio, or known as price earning ratio, is the proportion of a company's share price to its earning per share. We can know a high PE ratio could mean that a company's stock is overvalued, or that investors expect high growth rate, and it tells how much the company is paying for each dollar of earning. So for Cepat Wawasan Group Berhad, the price earning ratio for 2022 is 6 ringgit and 68 cent, with price per share and EPS are 68.2 and 10.21 respectively. Meanwhile, the earning per share in 2023 is 6.6 times, with price per share and EPS are 73.99 and 6.6 respectively. They show that For every 1 ringgit in share, the company generate income 10.1 10.21 in 2022 and 6.6 in 2023. So we can conclude Cepat Wawasan Group Berhad have a price earning ratio higher in 2023 than 2022. So that's all from me. Thank you.
Assalamualaikum. My name is Ashira Shazam binti Rida, matric numbers 289908. I will be presenting to you about the discussion of the company's performance. Cepat Wawasan Group Berhad, also known as CGB, demonstrated notable changes in its financial ratios from 2022 to 2023. The liquidity ratios, particularly the current ratio, improved from 3.06 in 2022 to 3.43 in 2023. This suggests that CGB enhanced its ability to cover short-term liabilities with its short-term assets. Although the high ratio might also imply excessive idle capital, similarly, the quick ratio rose from 2.45 to 2.87, indicating a better capacity to meet short-term obligations using the most liquid assets. Both ratios being significantly above 1 reflect strong liquidity but might also indicate inefficiency in assets utilization. In terms of activity ratio, the inventory turnover ratio increased from 11.16 times in 2022 to 11.96 times in 2023, showing improved efficiency in managing and selling inventory. However, the total asset turnover ratio declined from 0.72 to 0.61, indicating that CGB became less efficient in generating sales from its total asset. This means that every 1 ringgit in assets, the company generated less revenue in 2023 compared to 2022. Additionally, the cash conversion cycle increased significantly from 36.49 days in 2022 to 70 days in 2023, reflecting a considerable slowdown in the company's ability to convert investments in inventory and receivables back into cash, indicating decreased operational efficiency. The profitability ratios presented a mixed picture. The net profit margin data for 2023 appears erroneous as it shows an possibly high value. Assuming the data is corrected, a higher net profit margin typically suggests better profitability. The return to assets saw a slight improvement, increasing from 4.366% in 2022 to 4.53% in 2023, indicating marginally better efficiency in using assets to generate profit. In contrast, the return to equity declined from 8.228% to 5.050%, signifying a reduction in the company's effectiveness in generating profit from shareholders' equity. This decline could indicate deteriorating profitability and efficiency. Regarding leverage ratios, both the debt to assets and debt to equity ratios decreased, reflecting a slightly reduced reliance on debt financing. The debt to asset ratio went from 18.886% to 17.93%, and the debt to equity ratio also showed a decline, suggesting a more conservative capital structure and a marginal reduction in financial leverage. This is generally favorable as it indicates lower financial risk. Market value ratio showed the earnings per share drop from 10 ringgit 21 cent in 2022 to 6 ringgit and 60 cent in 2023, pointing to a decline in profitability per share, potentially due to reduced net income or increased shares outstanding. Conversely, the price to earnings ratio increased from 6.68 to 11.21, which could mean that investors expect higher earning growth in the future or that the stock is overvalued. This increase suggests an improved market perception of the company's future profitability or a higher valuation relative to its earnings. In summary, while Cepat Wawasan Group Berhad improved its liquidity position and slightly reduced financial leverage, it faced challenges in operational efficiency and profitability. The increase in liquidity ratios indicates better short-term financial health, but the decline in asset turnover, net profit margin, and EPS, along with the increased cash conversion cycle and lower ROE, highlight areas needing attention to enhance overall efficiency and profitability.
Hello everyone, my name is Shafina Begum Surajudin. My matric number is 290515. Today I'm going to talk about suggestion and conclusion part. So first is suggestion. So based on the analysis of Cepat Wawasan Group's Berhad's financial performance, it is recommended that the company focuses on improving its liquidity position by managing its current assets more effectively. This can be achieved by optimizing inventory levels and ensuring efficient cash flow management to enhance the current ratios. By maintaining a current ratio above 2.1, the company can demonstrate its ability to meet short-term obligations and mitigate liquidity risk. Furthermore, this company should consider enhancing its profitability ratios by increasing revenue streams and controlling costs. Improving profit margins and return on investment can indicate a more efficient use of resources and better overall financial performance. By implementing strategy to boost profitability, the company can strengthen its financial position and attract potential investors seeking sustainable returns. In addition, it is advisable for Cepat Wawasan Group to regularly review both financial and non-financial performance indicators to gain a comprehensive understanding of its business operation. By incorporating metrics related to customer satisfaction, process efficiency, and growth opportunities, the company can align its strategies with broader business objectives. This holistic approach to performance evaluation will enable this company to make informed decisions and drive long-term success in a competitive market environment. In addition, it is advisable for Cepat Wawasan Group to regularly review both financial and non-financial performance indicators to gain a comprehensive understanding of its business operation. By incorporating metrics related to customer satisfaction, process efficiency, and growth opportunities, the company can align its strategies with broader business objectives. This holistic approach to performance evaluation will enable this company to make informed decisions and drive long-term success in a competitive market environment. In addition, it is advisable for Cepat Wawasan Group to regularly review both financial and non-financial performance indicators to gain a comprehensive understanding of its business operation. By incorporating metrics related to customer satisfaction, process efficiency, and growth opportunities, the company can align its strategies with broader business objectives. This holistic approach to performance evaluation will enable this company to make informed decisions and drive long-term success in a competitive market environment. In conclusion, this assignment has provided valuable insights into fundamental financial concepts and ratios used to assess a company's performance. Through the analysis of Cepat Wawasan Group Berhad, we have gained knowledge about the significance of profitability statistic and the cash conversion cycle in evaluating a company's efficiency and also the financial health. We also face some challenges in understanding the certain formulas and also the incorporating non-financial factors. This assignment has enhanced our ability to evaluate a company's overall performance and make informed decisions using a range of metrics. It has been a valuable opportunity to apply theoretical knowledge to real-world financial analysis and develop a comprehensive understanding of company performance evaluation. That's all from me. Thank you.